Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined the Equity Mates community for the very first time, a huge welcome. We have a big episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm going well, Bryce. Very excited for this episode. We are back into the swing of things. Last week, we did our bold predictions and we shared our stock of the year. And we're back with our regular scheduled Monday episode. We're going to talk about the news. We are going to answer a community question on some very popular ETFs. We're going to put them head to head, DHHF and VDHG. And then we're going to talk, we're going to give, I guess, a refresher on how we invest and why it works. We know there's a lot of new people who have jumped onto the podcast recently, so we thought it'd be worth explaining our investment strategy, how we invest our money.
Yes.
Big episode.
Huge episode. Also, we have our community survey now live. You will find a link in the show notes wherever you are consuming this episode. The survey is an opportunity for you to provide us with feedback on everything that you love about Equity Mates, everything that you would like us to change, or what you would like to see more of. We take it very seriously. Last year, you wanted to see more news, so we changed our newsletter to daily and now give you the news of the day. We also have a few shows that we're developing that are off the back of the survey. So please go in and fill it out. It doesn't take long. I would say 10 to 15 minutes. And if you complete it in full, you'll also go in the running to win $500 cold hard cash, which you can throw into the markets or Trump Memecoin.
Yeah, but preferably the markets. Yeah, please go and fill out that survey. Link is in the show notes, or it will be across our socials. But Bryce, let's get into it.
News and markets.
All right, Ren. Well, we can't start the news without talking about Mr. Donald Trump.
Yes.
Who is now a crypto billionaire.
Crypto billionaire. Last week he became a crypto billionaire and the US president.
What a week.
Which is he more stoked about?
Crypto billionaire.
Yeah.
For sure.
So we'll give the story for those that didn't hear it. So the Friday before he was inaugurated, on the 18th of January, Trump truthed on Truth Social that he was launching a Trump cryptocurrency. The ticker was Trump.
Yeah.
It's called the official Trump coin. And within a few days, it reached a fully diluted market cap of more than $70 billion. Now, it's important that we stress that's fully diluted because 80% of the supply of coins is being held by Trump affiliated companies.
Yeah.
And so the actual market cap of free floating coins that can be traded is far less than that. It's still in the billions, but it was I think it reached a top of 10 billion or something like that. But on paper, Trump had about $55 billion worth of this cryptocurrency, which meant at its peak, it was 89% of his wealth.
Yeah.
55 billion or 56 billion from the Trump cryptocurrency, about 4 or 5 billion from the Truth Social shares that he owns.
Yes.
And then a lifetime of real estate development and everything else that he's done, branding everything from steak knives to universities, 2.6 billion.
Which is nothing to be sneezed
No,
at.
but it just shows 2.6
crazy.
billion for his life's work compared to 56 billion in 4 days from a cryptocurrency.
It's a J up. It's a J up. Anyway.
So the story doesn't end there. Obviously, the Trump family celebrated the success of Trump Coin's launch because I think 3 days later, Melania Trump launched her cryptocurrency, Melania. And it reached a fully diluted market cap of $8 billion.
Yeah.
Yeah.
Melania's done pretty well for herself over the last few weeks. She was paid $40 million by Amazon as well, for the rights to make a documentary about her that, from memory, she will be producing.
No, I think it's already produced, and they're buying the rights to air it, to broadcast.
Oh, they've already made it.
Or she's going to be a producer on it. Yeah, I can't remember. But
Either way, she's cleaned up.
Yeah. And she wore a very big hat at the inauguration.
Yes. Well, so speaking of the inauguration, both coins fell 20% during the inauguration.
Which I think is surprising.
Yeah.
You would have expected Trump becomes president, the Trump coin increases in value.
Yeah, probably because he didn't speak about crypto enough in the inauguration
I think it's a reminder that people who are like in the crypto world use these moments to then sell.
Yeah.
So it reminded me of the Elon going on Saturday Night Live back in 2021.
Yes.
And everyone thought Dogecoin would get to $1
yeah.
when he went on Saturday Night Live.
Yeah.
But instead it actually fell. And it fell, I think, because early holders were selling into the teeth of the hype.
Yes.
And I think this was probably similar. Look, it's an avenue for grift, and like not saying that this is why he was doing it because we don't want to get sued. But if you couldn't take a bribe as a president, you couldn't be given $100 million cash.
Yeah.
But you certainly could be influenced if maybe a foreign government bought $100 million worth of a cryptocurrency and that buying pressure pushed up the value of your holdings in that cryptocurrency. So I'm not saying that that's what would be done. It's just saying that the door perhaps opens for such things.
Yes.
Anyway.
I'm sure it'll all come out. Let's keep going. Bringing it back home, struggling casino operator Star Entertainment Group, listed on the ASX, SGR, saw their shares fall 18% last Monday after flagging a 15% fall in quarterly revenue and warning that there is a material uncertainty about its ability to continue operating.
You'd think if there was one business that you couldn't go wrong with, it's
casinos. I know. Their stock is already down 40% for the year.
Yeah.
Now, just to put some numbers to that, they burnt $107 million in cash for the 3 months ending 31 December.
Like they lost it.
They lost 107 million. They only have $75 million in cash at the moment. So that is why they are saying there is a material risk that we actually run out of money in the next quarter. And I heard as well that they are now putting pressure, or at least asking the New South Wales and Victorian governments, New South Wales and Queensland government for tax relief. I think Mins to date has said he's not interested in entertaining that, no pun intended. But we'll see.
Yeah, it's a interesting one. Someone will buy it.
You'd think so.
Yeah, like
You'd
private
think
equity
so.
or something.
Yeah, come in and scoop it up.
Yeah, but that will be one to watch. Another news story that we think is important for Australian investors to be across is the iron ore story.
Yeah.
Because Westpac came out and issued a warning for anyone who is investing in the big Australian miners, or perhaps made bold predictions about how well the big Australian miners would go in 2025, like my my co-host here. So Westpac predicted that the iron ore price could fall about 30% this year. It's right now just above $100. They think it could fall to about $70 a ton, and that's mainly because additional supply will come online, mainly from Rio Tinto. They've got their latest Pilbara project, the Western Ranges, coming online, and then also the Simandou project in the Republic of Guinea in Africa, and that on the supply side, and then continued weakness on the demand side from China, etc.
Yeah.
They think it could be a bad year for iron ore, which would be a bad year for Aussie mining stocks, but importantly, it would be a bad year for Australian government revenue as well. It would be a bad year for the budget as well.
Big time.
So that's going to be an important story to watch, because a lot of Australia's economic prosperity relies on digging stuff out of the ground.
That's it. Well, fingers crossed. My bold prediction was very much tied to the iron ore price.
For people who missed that episode?
The bold prediction was that the Australian mining sector would outperform the banking sector, but part of that was tied up in the mining sector actually going well. It could still play out if they both do shit.
Yeah.
I still need the mining industry just to not do as shit as banking. But that wasn't quite the thesis.
Yes.
Now, to close out, TikTok is back after a very short ban over in the US. So the story here is that TikTok briefly went dark in the United States. The US Congress gave ByteDance, which is the Chinese owner of the social media giant, 1 year to sell its US operations. The deadline was reached on the 19th of January, a day before Trump's inauguration. It wasn't sold, so ByteDance just cut access to US users. I think about 120 million or
170 million.
170 million users went dark overnight. I was wondering how many then quickly downloaded some sort of VPN to try and get things back up and running.
Have you seen what has been happening? A bunch of American users have been downloading Red Note,
Yeah.
which is a Chinese Communist Party operated app, like actually operated by the CCP, not TikTok, where they're saying that there's like the control from the government.
Yeah.
And when you sign up for Red Note, you basically have to agree to live the values of the Chinese Communist Party or something like that.
Silly.
So
silly. Anyway, as quickly as TikTok was shut down, though, it came back online after US President Trump confirmed that he'd be signing an executive order to give ByteDance a 90-day extension to try and find a buyer. In a Truth Social post, he also backed away from US law demanding the full sale of operations and instead stated, "I would like the United States to have a 50% ownership position in a joint venture." I'm sure he would. He's obviously changed his tune quite significantly because last time he was in, he wanted to get rid of it. This time, he's realized how much it helped him with the election. And so he's absolutely in love with it.
Couple of thoughts from me. First of all, TikTok has played an absolute masterstroke in going dark, but voluntarily right before the deadline. And then this is the message that they put up. Sorry, TikTok isn't available right now. A law banning TikTok has been enacted in the US. Unfortunately, that means you can't use TikTok for now. We are fortunate that President Trump has indicated that he will work with us on a solution to reinstate TikTok once he takes office. Please stay tuned.
Trump be loving that.
Just put the pressure on Trump, but also really gave him the glory. And so Trump has saved TikTok for the 170 million Americans that are users of it. My second thought is all these lawmakers, particularly American lawmakers, but also Australian lawmakers, keep coming out and saying, we have classified information on just how big a security risk TikTok is. And it's like, just, you have to trust us. I understand that they don't want to share the classified information because it will probably reveal some methods of intelligence intelligence collection that remain quite valuable. But I feel like we're getting to a point where, like, if it is a bigger risk as they're saying, just show us. Figure out a way to show us something.
Shock therapy.
Because otherwise, you know what's going to happen is TikTok's going to stick around. It's going to keep growing, and it's going to be harder to ban in the future.
Definitely.
Like, really, if this was such a big security risk, it should have been banned when there was. Anyway.
Well, we had our moment. Will be interesting to see how this all plays out. Now, Ren said at the top of the show that we were going to do a bit of a refresher on why we invest and what our strategy is. For those of you who have just joined the show and want to understand a bit more about what we're doing, and a bit of a refresher for those that have been with us for the last 8 years. So
we invest in a core and satellite approach. Core being I guess it's like global low-cost index tracking ETFs, which we can explain some of those terms. But really core is essentially trying to buy the whole market and just take the share market's average return. And then the satellite portion of our portfolio, we're trying to beat the market. So we're trying to pick individual stocks or choose active managers or perhaps buying other assets like crypto to try and beat the market. And so that's our approach. And I guess we wanted to just explain why we think it makes sense for people who are approaching 2025 as I'm going to start investing this year or I'm going to take the next step. Why does this core make sense? Well, first of all, I guess we really have to explain what I said before. Global low-cost index tracking ETFs. What are we actually investing in there?
In its simplest form, Ren, that means we are investing in everything. And the way we do that is through indexes, which are perhaps the most elegant investment product on the market. What indexes do is allow us to wrap up large quantities of companies in different geographies. So I can take the top 200 companies here in Australia, top 500 over in the US, top 100 in the UK, wrap them all up, and in one simple investment, get access to all of them.
The analogy we use in our books, which you can read if you want more on this, links are in the show notes, is the fruit salad analogy. So traditionally, when you're an investor, you had to buy individual stocks, i.e. individual pieces of fruit. But what the index has allowed us to do is to buy the fruit salad, with the one slice of apple being Apple, one slice of banana being Microsoft, one slice of rock melon being Meta. You get the analogy. And in one transaction, we can buy a little bit of everything.
Yeah.
Now, index investing really only came about in the 1970s, and you may have heard of Vanguard. The founder of Vanguard, John Bogle, had the thesis that rather than trying to pick individual stocks, investors would be better served just buying a little bit of everything and taking the overall market return. And fast forward 50 years now, and he was absolutely right. And we can talk to some of the numbers that prove that out in a second. But the first part is indexes are just, as you said, buying a little bit of everything.
So, Ren, when Bogle was around, the most common way of buying these indexes was with paper-based forms.
Yes.
Pretty annoying, pretty frustrating.
Sending a check in the mail.
Yes, yeah. Good news is today the innovation is the ETF, or the exchange traded fund. Very common way now to get access to buying these indexes. One click, you're in, through all access through our online brokers. And I mean, it's as easy as buying, as we've said, socks on Amazon.
Yeah. Stocks or socks,
Yeah,
just as easy as
just
each
as
other.
easy.
You can buy it with smaller amounts of money because of ETFs. You can sell it just as quickly. It has really changed the game.
Yeah.
And so then the question is, why are index ETFs the core of our portfolios? They're quite an elegant investment product because every quarter they get rebalanced, and the companies that are growing on the stock market get added, or they take up a bigger size in the index, and companies that are falling get booted out, or they take up a smaller section. And that quarterly rebalancing process makes them, in our opinion, the only truly timeless investment product, because that quarterly rebalancing can really go on forever. You'll always get more of the good and less of the bad. The thesis that John Bogle had worked.
Yeah.
And so to talk to some of the numbers, the Australian stock market since 1900, with dividends reinvested, has returned 13.1% a year.
Awesome.
And the US stock market over the past 100 years with dividends reinvested has returned 10.6% per year. Now, those numbers in isolation probably don't mean a lot to people, 13%, 11%, what does that mean? So we put it in a compound interest calculator, and here are the numbers. If you can invest $50 a week for 40 years and get 10.6% return, you have $1.4 million.
Epic.
So that's the US. If you can invest $50 a week for 40 years at 13.1%, you'll have $2.7 million.
Yeah.
So, the idea of becoming a millionaire, the idea of, setting yourself up financially, it's not out of reach, and you don't have to pick individual stocks. You can just buy a bit of everything and let the market do its work.
Yeah.
As the economy gets more productive, as new businesses come to market, as disruption happens, you'll benefit by owning a little bit of everything.
Yeah. And here's the other thing. Those numbers, 13.1%, 10.6%, that's actually really hard to beat.
Yeah.
An alarming amount of professional managers struggle to beat that. And here's some numbers from the Spiver scorecard. So in the US, over the past 10 years, only 15% of fund managers have been able to outperform the market. And in Australia, over the past 10 years, only 18% have been able to outperform. So that is a huge number of professionals who are taking fees and telling you that they can do better than just taking the index and you having to do nothing.
Yeah. So that's our core strategy. You can literally just buy one globally diversified ETF, index ETF. Some examples that we often speak about, the codes in Australia would be DHHF, VDHG.
Which we'll unpack after the break.
We are going to speak about those. So we'll just talk about those two, just to keep it consistent. But there's a bunch out there. We've done a bunch of content on it. But if you just set up your core like that and you regularly invested into that,
that is enough.
Honestly, you could stop there.
Yeah, absolutely.
And we don't stop there, and we'll talk about our satellite investing in a second. But I think that's for people who are like, I'm going to start investing in 2025, I'm going to listen to Equity Mates, and I'm going to set myself up, that's all you can do. You can honestly stop listening to us for the rest of the year. These days, you can automate that process with platforms. You can get paid, automatically transfer something to your brokerage. You can automatically buy one of these index ETFs, and you can listen to a podcast that might interest you a little bit more. We hope you stick around, but that is honestly as simple as it needs to be. And if you want to read our book on that, it's called Don't Stress, Just Invest, and it's available wherever books are sold. But Bryce, we like to take it a step further. We also have a satellite investing strategy. So why do we go further?
Because we love it. No, I think there's two. Well, that is one part. We love investing. We love finding out about new companies, exploring industries, and the intellectual stimulus that comes from thinking beyond just your core positions.
Yep.
But also, there's part of us that wants to be able to beat the market. And even though we've said that it's an incredible hard thing to do, doesn't mean you shouldn't try. And having an X proportion of your portfolio set up to try and beat the market, that's how we like to set it up.
Yeah, and we've said it's hard, and we've said a lot of professional fund managers don't beat the market, but we spoke about our portfolios a fair bit last year, and we looked at the numbers, and we have been able to pick some winners, and that is certainly motivating to then go and try and find the next winner. And we love it. We obviously do it for a job now, and it can be done if you put the time in, I think is probably...
Absolutely.
Yeah. So the thing is, though, the majority of our money is invested in our core, and then we have this satellite position, which is a bit smaller. So I sort of do 60-40 core satellite. What about you?
I'm more 80-20, 80% into core, 20% into satellite. To be honest, my satellite positions, I would say over the last 18 months, haven't gone... in fact, I've probably decreased my satellite positions a lot, did a lot of consolidations. But this year, I have a feeling that might change.
Yeah, okay. Interesting.
Yeah.
And so if you're wondering what the rules are generally around how much should go to your core, how much should go to your satellite, there's no hard and fast rules. It depends on your risk tolerance and how much time you can commit to investing and doing the research and doing the work for your satellite portion of your portfolio. If you have no time, you can go 100% core. I would probably say at least 50% core. At least, just recognizing how hard it is to beat the market, how few professionals do it over the long term. You probably don't want to back yourself more than that.
Yeah, and I don't know if it's a psychological thing, but the more cash you put towards your satellite, I feel like the more you're going to overtrade it and
that's interesting.
Think that you need to be active and put it to work, if that makes sense.
Yeah.
If you limit, I don't know, this is just kind of how I think about it. If you limit what you have available, you force yourself to be more conscious of what you're buying. Yeah,
only buy the best rather than be like, I need to be
in the market.
I need to find the next opportunity.
Yeah,
that's interesting. So look, that's how we invest and why it works. The numbers back it up. Intuitively, if you think about what the stock market is, it's literally just a collection of businesses that employ people to make more money for their shareholders.
Yeah.
Like every business is constructed in that way. They're all incentivized to make more money for shareholders. They go out and produce new products, enter new markets, hire new people, all to drive more profits, to make more money for shareholders. And as individuals who are just trying to, get their money right and build wealth, it's an opportunity that you don't want to pass up because you can invest in a lot of things. You can buy Trump coin, or you can buy a house, or you can buy a bar of gold, and some of them have been great investments, but nothing is like the share market in the sense that they're living, breathing things that go out every day to make you more money.
Yes.
And that's the opportunity set we have.
We have a community question that has come through from Eleni that we will answer in a moment. A reminder that if you would like to ask a question, there'll be a link in the show notes or in the description below. We love hearing from you, so please leave a voice note. But let's take a listen to Eleni's question.
Hey equity mates, could you please compare the Vanguard Diversified High Growth Index ETF to the BetaShares Diversified All Growth ETF? I have my safety funds all set up and want to start investing. My plan is to invest a $5,000 lump sum upfront and then dollar cost average roughly $200 weekly. I want to invest in something that I don't have to think about and can just let grow. Which of these two ETFs would you invest in for this scenario, or do you have an alternative suggestion? Thank you.
Great question, Eleni. Thank you so much for sending that in. And she's chosen two of the most popular ETFs that are in the Equity Mates community, VDHG and DHHF, both of which we classify as or call your all-in-one ETF. Now, Ren and I spoke about a core portfolio earlier. These are essentially pre-made core portfolios. Both of them have underlying ETFs that are then put together by the managers to give you access to effectively thousands of stocks globally.
Yeah. So to be really specific about that, they'll have a Australian funds section, which might be, depending on the ETF, about a quarter of it. Then they'll have international stocks, so it might be another quarter to a third. They'll have
emerging markets.
They'll have emerging markets. VDHG will have a little, about 10% allocation to bonds. And so that way it's all in one because you don't need to buy other things to be diversified. That product is diversified across countries and different market sizes in terms of small caps, large caps.
So let's look at some of the key differences. You always got to look under the hood. You can find all of this information on the issuers' websites. But we've got to start with asset allocation because there is a slight nuance between the two. The Vanguard ETF gives you 90% exposure to growth assets, or effectively shares and property, and a 10% exposure to defensive assets, which is bonds. If you compare that to BetaShares DHHF, it is 100% exposure to stocks. So no bonds in there.
Yeah.
Secondly, you then got to look at the management fees. So VDHG 0.27% per annum. DHHF is 0.19% per annum. And then geographic allocation. We both just said that it gives you global exposure. The nuances, the Vanguard has a higher allocation to Australian shares, about 36%, whereas DHHF has a little less, 27% of the ETF gives you exposure to Aussie shares.
So let's put that together and have a look at the performance of the two ETFs. So DHHF was launched in 2020. Since inception, it's up 12.05% a year. Pretty good.
Yeah.
VDHG was launched in 2017, so it's been around a little bit longer. It's seen a little bit more market turmoil, but a little more growth as well. It's up 9.4% a year.
Yeah.
So DHHF has grown faster. The question is why? Two big answers. First of all, VDHG has more exposure to Australia and therefore less exposure to the US. And the US has really been the growth engine of the past, call it decade.
Yep.
And then the second one is VDHG has a 10% allocation to bonds. Yeah. And actually this allocation to property probably has slowed it down a little bit as well.
Yeah.
So, 12%, 9.5%, it is a meaningful difference over time.
Yeah. And
to give you a sense of what that difference looks like, I just used the compound interest calculator. So Eleni has a $5,000 initial deposit and then is investing $200 a week. And I said over 30 years, let's use 30 years as the time horizon. 9.5% will get her $1.6 million.
Yeah.
Love that.
Yeah.
Nothing wrong with that.
No.
But 12.1%, $2.7 million.
Wow.
So it's an extra $1.1 million. So like those small differences really do add up over time.
That actually makes a significant difference. So in terms of the specific situation, Eleni, love the strategy that you're going after. $5,000 up front, $200 DCA weekly. I think nothing wrong with that strategy as a core. You mentioned that you've got your safety fund set up. I assume that's your emergency fund as we've said in our foundational series over on Get Started Investing, make sure you have your emergency fund set up before you start investing, so you are well positioned to get stuck straight into it. I would say DHHF is perhaps more suitable if you've got that super long-term horizon. Fees are slightly lower, and you don't want so much exposure to the Australian share market. It's 100% growth assets. If you're young and you don't need to be so defensive, then for me, this is the one that I would prefer. Having said that, VDHG is still a great solution. Does have a little bit of bonds in there, so is a little bit defensive, less volatility. And if you love Aussie stocks and want to take advantage of some of the tax situations around franking credits and the like, there's a little bit of a nuanced advantage there as well.
Yeah.
But I think both of them offer a great starting point for a core portfolio.
Yeah, I agree. So get started is what I'd say.
Yeah.
And if you're in a similar position to Eleni, you don't need $5,000 up front or $200 a week to get started with this. Platforms these days, you can get started with literally $1 on some of them. Yeah, there's no excuse is what I would say to make 2025 the year you start investing.
That's it.
Or continue investing.
Yeah, whatever. Or go harder. Now, a reminder, there's a link in the show notes to two things. Firstly, the community survey. We would really appreciate if you can take 10 minutes to complete that. And secondly, if you want to ask us a question, there is a link for you to do that as well. And thirdly, I should say, is our daily email is back up and running. So make sure you're signed up to that. We'll also put a link in the show notes to that. Every day we'll send you a condensed version of some of the big headlines from around the world that we think are important, as well as questions answered by experts. So yeah, it's make sure you sign up to that. Don't miss out.
Yeah, well, that will do us for today. Stay tuned on the Equity Mates channel, because tomorrow we're speaking to Glenn Hare. He's a financial advisor at Fox & Hare, and we're back for our first Ask an Advisor episode of 2025, where we take your questions and we put them to some of Australia's best financial advisors. So subscribe wherever you're listening or watching so you don't miss that, and we'll see you next time.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.